Hello everyone. On behalf of Icertis and PwC, we'd like to welcome you to this video series on contract intelligence in the insurance industry. My name is Jim Burnick and I'm from Icertis. My background is over 30 years of banking and I'm here with Matt Wolf. Matt, you want to introduce yourself?
Hello, my name is Matt Wolf. I'm a cloud and digital partner with PwC. I've been in the insurance industry for about 2 decades. And my role is to bring large technology programs into the insurers to improve their customer experience, lower their policy acquisition costs, and improve their risk transfer process.
Excellent. Well, Matt, let's get started. And let's get started by talking about some trends in the banking and the insurance industry as we look at 2024. You know, when you think of the two industries, they really are closely linked. You know, banks now have insurance lines of business. Insurance has banking lines of business for their deposits. You know, you got flow sides of the business that are very retail focused, consumer focused, very important to have straight through processing. In banks, that would be deposit, savings, those type of things. And then you got these complex areas like capital markets and, you know, there's other areas of insurance that are more manual and complex. So, besides that, you know, there are industries that are very heavily regulated, that have a lot with risk management, involved with risk management. And then I would say the third area is efficiency. All of them are striving for efficiency, digitization, and operations. You know, I think those are the three trends that we're seeing in banking. How about insurance?
Yep, I think, as you said, right, so these are insurance and banking are like close cousins, right? So many of the dynamics in the economy that impact the banks also impact the insurers. I think you know, maybe one of the additional nuances on the insurance market is, you know, while we're selling a legal contract, right, and it's very much a financial services product, you know, we are still ultimately connected to the physical world, right? So things like catastrophe risk, the increase in hurricanes, windstorm fires in California, things like that, you know, ultimately those impact the insurers as well. Mm-hmm. The interesting, I think, dynamic for us in the past several years is that the primary insurers, the ones that we all know about, right, that spend $1 billion every year on the Super Bowl and things like that, they've historically been able to basically wear some of that risk, pass some of that back to the reinsurance community, some alternate capital areas, and there's always been that appetite. As you said, as the cost of capital has increased, the frequency and severity of the losses have occurred, we're starting to see a tightening of that backstop capital. And so now what's happening is then now that's making the primary insurers, who we all know, start to rethink some of how they're actually going to underwrite and accept the risks. So when you see in 2023, 2024, certainly in probably the next couple of years, you know, there's going to start to be some areas of the market where traditionally there was always services. You could always buy a home insurance policy in Florida. We're going to see some tightening in that market. And it's really because there's multiple parties acting kind of in concert in the industry and making sure that they're all aligned, making sure they have good data, making sure that we're making good real-time information and decisions. That's going to start to become really critical for the carriers as they start to navigate this more uncertain world.
How about insurance? Applying it to contract intelligence.
So when you think about it, the insurers, you know, they, from a terms of a counterparty and supply chain, right, there's multiple various areas here where the insurers can really improve. Certainly in terms of claims payments, right? So fundamentally the insurer needs to be able to re-indemnify an insured, and so there's a lot of supply chain around just like, let's say for example in homeowners and physical rebuilding, right, and contracting. If it's in a commercial space, there's business interruption and they might not have to go to some other facility, industrial facilities that could continue operations. So understanding those contracts and who those third-party providers are is important because it's such a large cost driver for the claims cost within the insurer. On the other side of that, as I was saying before, with the reinsurers and the brokers and things like that, that's the money coming in-house into the insurer, and likewise understanding those contracts, understanding the terms, making sure that the insurer is making really good risk decisions as those contracts are coming in, particularly on commercial insurance.
I'd be remiss if I didn't talk about artificial intelligence as part of the trends in the industry and where it's going to, including us with contract lifecycle management, contract intelligence. How do you see that applying to insurance? Is insurance investing in AI?
Yep, absolutely. So I think certainly with the advent of the OpenAI LLMs, the GPTs of the world, you know, one of the things that the LLMs done they've really democratized access to AI models. Historically, in the past, those were really kind of sitting within data science and actuarial teams within the insurers. And so there's always a need for those as well. I think in particular, PwC's position is that anything you're doing around AI has to be very explainable because, again, we're very regulated, right? So we don't want to create use cases where the AI made a decision and we can't understand why it did that, right? So we always want to take a risk-based lens around how we use AI. With that said, there'll be some more traditional models that we've already kind of been using in the past couple decades. Those will continue to be used. We don't fundamentally see a shift there. Where the LLMs are interesting, and again, within the context of here, is that the LLMs effectively don't have the same training overhead, right? So they're more accessible.
Yep.
And also what you can do is you can really bring a very large, as you said, corpus of data into those and then start doing insight generation out of it. And you can talk to it in terms of natural language. So in certain areas, like let's say we have this large set of historical contracts that we have existing today, it's really a good use case to use an LLM to extract that out, match that against performance, see what actually works, see what hasn't, what's the outlier, and now we can start actually applying that into like real-time insight for when new contracts come through, right? And does this fit something that we want? So first thing is just around kind of that and surfacing that insight. The second thing that we see around AI in particular is that the LLMs in general will not be smarter than the smartest person in your company, right? Those people still have that special, institutional knowledge. They have that experience, right?
Maturity, yeah.
But what we do see is that there's lots of new people that come into your company, right? And they're not going to have that same benefit. So using the LLM, using the Copilot model, if I can in natural language say, tell me how I should structure this part of this contract for, let's say, a commercial insurance policy, that really closes that gap. So that knowledge learning curve for the people who might be below the midpoint around skill, that's really where you start to see the LLM adding a lot of value. So it's not necessarily that we're taking the top and bringing them down. It's like we're bringing the bottom up. And so that's where we're seeing a lot of good use cases, a lot of kind of point-in-time training. It's, as I said, the fact that you can naturally ask the question is very approachable for people. So that's generally where we're seeing it, and the insurers are absolutely investing in that space.
That's a really good perspective. So let's move on to the different areas of contracting. So when you think about contracting, there's a buy side and there's a sell side, right? Without the right technology, without being able to monitor those obligations and track them systematically, digitally, it really inhibits productivity, efficiency, and the customer experience. Do you see the same thing in insurance, especially on the sell side area?
Yeah, absolutely. I think maybe again 2 points on this. The largest purchaser of carpet in the United States is an insurance company, right? So there's lots of opportunity to apply contracts to very large purchasing contracts, right? Obviously when you have a fire, for example, right, the insurer has to coordinate quite a bit of that. So there's always that, right? I never want to minimize that because that's a large cost driver. And then as you said on the counterparty side, right? Absolutely, it's a very insurance has matured over many years, decades, right, to operate in a certain way. And so how the primary insurer works with the reinsurance company, how do they work with the broker, how do they work with the actual risk manager, let's say on commercial that's actually buying the insurance, or the customer on personal lines retail. These are all various parts of the contract moving back and forth. And again, at the end of the day, the insurers, we don't sell cars, we don't sell widgets, right? We're selling a legal contract. So having the right tool that surfaces that up, creates the right guideline, and as I said, creates the right insight at the point of underwriting or issuing that policy is really important. So absolutely, we see it across every part of the value chain. And the really good leading insurers, when we actually look and say to the retail broker side, we say, what makes you want to choose an insurance company, right? Because the brokers actually have a very influential determinant around what insurer actually gets the business. And one of the things that we consistently hear is around this concept of responsiveness. Now, initially, it's a little bit awkward because you're like, what does responsiveness mean? But when you really think about it, it's kind of the case where you said where there's multiple parties and multiple steps in the enterprise that elongate the whole process.
Yep.
The more that you can compress that and get a quote out quickly, or at least at a minimum say where is it in the process, that is, to me, what responsiveness is, right? It's clarity and it's speed to making sure that the broker and then the person that's trying to buy the insurance understands where you are. If you ask for a quote and it goes into a black hole for 3 weeks, it's very unlikely you're going to win that because someone else probably came back first.
Right.
And so speeding that up and compressing that time, that's a competitive differentiator for the companies that are doing it well.
In the insurance industry, how much do you see in centers of excellence for things like contracting, where that workflow can be standardized?
I think it varies based on which part of the market, which is definitely the trend in insurance. On personal lines, there's a lots of investment around direct-to-consumer, right? So a lot of where they're trying to basically invest is making that kind of that quoting, that buying decision very easy and really disintermediating it. Where you see it in commercial is it's a little more complex, right? So there frequently they'll be working with either a BPO provider or they'll be working within a COE that they own in-house. That as you know, we talk about KYC and making sure the right broker has the right clearance, and is this someone that already maybe has a submission from someone else? There's a lot of work that has to happen up front, even before it really gets to the underwriting decision. And so those are areas where they have tried to consolidate that because you can achieve some scale there. And then effectively try to make some risk decisions early, kind of do some straight through processing decision. And if it's kind of passes through all those steps, then they'll actually try to get it to the underwriter, because the underwriter is the specialist that would make that decision. So there are lots of parts of that within the value chain right now. Again, can you automate a good part of that up front? Absolutely, right? And that's where the tools like AI and a contract tool can start interrogating those submissions coming in, doing that kind of analysis, and then actually making those decisions in real time. And of course, it's a big cost, right? It's a large cost up front. If you're manually doing all these submissions, a lot of insurers, they might only convert 20% of their submissions that come into an actual policy. So that's to say 80% of that work that you're doing is really a cost to the enterprise. And so the more you can actually reduce that cost up front, the better you can flow that back into the rest of the enterprise through better performance, better profitability.
Very interesting perspective. Well, thank you, Matt. So as you can tell, Icertis and PwC are heavily involved in business transformation and bringing benefits to customers with contract intelligence. If you'd like to hear more, please contact us and be sure to watch our other videos in our series. Thank you all.